Hello, everyone, and welcome back to our weekly session. I'm your speaker for today's webinar. My name is Shimona Jha, and together with me is Ms. Mehnur, one of our compliance auditor, and Mr. Mohammad Shehbaz Alam, CEO and founder of AMCA. For all the new joiners, this webinar I would like give a brief introduction of our company. We are from AMCA, Abdullah Al Marzuki Chartered Accountants, an auditing firm with a decade long experience. We are also registered in the Ministry of Economy to operate as licensed auditor as well as tax agent from Federal Tax of Authority. One of our previous webinar, we talked about the transfer pricing and its impact on business. So, for today's topic, we will discuss the calculation, payment, and refund of corporate tax. After the discussion of this topic, you can drop all your questions on our chat box, and Ms. Mehnur will be joining us to answer all questions by the end of our first half of the session. So, without further ado, let's start the discussion. In this presentation, we will be understanding the impact of exchange rates of financial transactions, navigating the complex landscape of corporate taxation, managing cross border payments and tax deductions, optimizing global tax liabilities through credits for taxes paid abroad. Furthermore, we have settling owed tax on company earnings, reclaiming excess paid taxes for business transactions. Let's start by understanding currency conversion in UAE dirhams for accurate financial reporting. Any amount quantified in another currency must be converted at the applicable exchange rate set by the central banks of United Arab Emirates, subject to any condition that may prescribed in a decision issued by authority. In principle, taxable persons are expected to translate the amounts denominated in a foreign currency at the time the relevant income is derived or expenditure incurred is considered for the purposes of the corporate tax law. This is subject to any conditions that may be prescribed in a decision issued by the authority. When converting a foreign currency to the United Arab Dirham, businesses should use a reasonable and consistent approach throughout the entirety of the tax period. Now, let's shift our focus to understanding the basic calculations behind computation of corporate tax. It is important to note that the accounting net profits as per financial statements of taxable person needs certain adjustments. We adjust this net profit by adding or deducting certain elements to end up on taxable income. Moving on, here is a glimpse of what needs to be adjusted as you can see on this slide. Firstly is unrealized gains or losses. Change in the value of an asset or liability before it is sold or settled. Example, forex gains and loss. Exempt income, which is dividend gains and other income from a participating interest. Relief and related party transactions. Business restructuring transactions and related party transactions on market value basis. Tax loss relief, use of a tax loss to reduce taxable income. Deductions. So this we will take up in our next slide in detail. In others, there is income or expenditure that has not otherwise been considered in determining taxable income as may be specified in a cabinet decision. Shifting gears to deductions now. It is important or common concern to know what is allowable as deductible expense when it comes to taxable income. We summarize these are deductions available which include revenue nature business expenses, net interest expenditure shall be deductible up to 30% of the taxable person's accounting earning before the deduction of interest, tax, depreciation, and amortization for the relevant tax period. Deduct 50% of any entertainment, amusement, or recreation expenditure incurred during a tax period. Now, let's discuss the settlement of corporate tax. And for the first point on the screen, you can see a taxable person's corporate tax due will be settled by using the taxable person's available withholding tax credit. If the amount of the taxable person's withholding tax credit is greater than the amount of corporate tax payable for the tax period, then the excess withholding tax credit should be refunded to the taxable person. If there is any remaining corporate tax due after fully utilizing the withholding tax credit, the taxable person can utilize its available foreign tax credit to settle their corporate tax due. For the use of foreign tax credit, if the amount of taxable person's foreign tax credit is greater than the amount of corporate tax payable for the tax period, any foreign tax credit will be forfeited and no refund will be given by the authority for the excess foreign tax amount. For the credits and reliefs, to the extent there is any remaining corporate tax due after fully utilizing taxable person's available foreign tax credit, the taxable person can utilize any credits for other forms or of reliefs as specified in a cabinet decision. Next up is withholding taxes. Withholding taxes are common form of imposing income tax on cross-border transactions and other payments involving non-residents, and in other situations where a withholding tax would provide a means of protecting the tax base. Points on the presentation provides the basis for the imposition of withholding tax, sets the applicable rate, determines its scope, and provides for its payment. The categories of state-sourced income derived by a non-resident person as prescribed in a cabinet decision, so far as such income is attributable to a permanent establishment of non-resident person in UAE, and any other income as specified in a cabinet decision. At the time of enactment of the corporate tax law, the applicable withholding tax is 0%. However, the applicable withholding tax rate could be changed through a cabinet decision. The amount of withholding tax payable is deducted from the gross amount of the relevant payment being made, and the amount withheld should be remitted to the authority within a prescribed timeline. This also specifies that the authority will prescribe the process, procedures, and timeline that will be followed to withhold and remit the tax deducted. Moving on to withholding tax credit. When a person becomes a taxable person during a tax period by, for example, forming a permanent establishment in the UAE, they can claim a withholding tax credit in relation to any withholding tax paid in the same tax period. If a person becomes a taxable person in a tax period, its corporate tax due under the corporate tax law can be reduced by the amount of withholding tax credit for that tax period. The amount of withholding tax credit will be equal to withholding tax in that tax period, unless the amount of withholding tax paid is greater than corporate tax due, in which case the withholding tax credit can only be claimed up to the amount of corporate tax due. A refund will be available to the taxable person if the withholding tax credit exceeds the amount of corporate tax due in the same tax period. This refund will equal the difference between the amount of withholding tax credit and the amount of corporate tax due. These provisions will become relevant and applicable when the UAE decides to activate its withholding tax mechanism and levy withholding tax rate at a higher rate than 0%. Up next is foreign tax credit. It is defined as the amount of tax paid under the laws of a foreign jurisdiction on income or profits that may be used to reduce the amount of corporate tax payable in the UAE. A foreign tax credit is available for any foreign tax that is of a similar character to corporate tax. An amount of tax paid in a foreign jurisdiction may be of a similar character to corporate tax where the amount is imposed by and payable to a non-UAE government, and the payment of such an amount is compulsory and enforceable by law in that foreign jurisdiction. In addition, the amount should be imposed on profit or net income, that is, income less deductions. The determination of whether a foreign jurisdiction's tax amount is similar in character to corporate tax is not influenced by factors such as separate legislation, tax nomenclature, or collection methods. Even if a foreign jurisdiction employs a withholding tax approach for corporate or business profit tax, this does not change the nature of the tax. Some jurisdictions levy taxes based on different components of the tax base, which may encompass both income and non-income aspects. If the foreign tax primarily related to income cannot practically be separated into distinct elements due to an administrative complexity, it can still be deemed similar to corporate tax if it meets specific conditions and exclusions do not apply. Corporate tax payment. This segment sets the timeline and a deadline for the payment of corporate tax. This provides taxable persons with clarity over the obligations and ensures that the authority is able to collect the corporate tax due within a reasonable time frame. The corporate tax payable under the corporate tax law must be settled within 9 months from the end of the relevant tax period or by such other date as directed by the authority. This coincides with the due date for filing of tax returns and means that the taxable person will be able to pay corporate tax at the same time as filing their tax return. This is consistent with the corporate tax being a self-assessed tax and is meant to minimize the compliance burden for taxpayers. A person who fails to pay corporate tax by due date will be in violation of the corporate tax law and the tax procedure law, and in such cases shall be liable for the applicable penalties. Lastly, we have corporate tax refund. Here we will discuss the eligibility and process for refund. It is necessary to allow for refunds in cases where taxable person have overpaid and we owed money by the authority. This article details the circumstances in which a taxable person can apply to the authority to obtain a refund of corporate tax. When a business entity referred to a taxable person has received withholding tax credits that exceeds the amount of corporate tax they owe, they can apply for a refund. Withholding tax credits are deductions made at the source when certain payments are made to the business. If these deductions are greater than the actual corporate tax amount the business is required to pay, the business can request a refund of the excess amount from the tax authority. The provision ensures that the businesses are not overburdened with excess tax payments beyond their actual liability, and any surplus can be reclaimed through a formal refund process. In cases where the tax authority, known as the authority, investigates and finds that a business entity referred to as taxable person has made a corporate tax payment that exceeds the actual amount of tax they are legally obligated to pay, the taxable person is eligible for a refund. This provision ensures that businesses do not inadvertently overpay their corporate tax and allows them to recover any excess amount they have paid beyond their rightful tax liability. The tax authority's determination and verification are essential to ensure accurate and fair refunds for businesses. When a business entity referred to as a taxable person applies for a taxable corporate tax refund based on excess withholding tax credit or overpayment, the tax authority, known as the authority, will communicate the decision on the application to the taxable person. This communication, known as a notice of decision, will detail whether refund has been approved or denied. The process for notifying the taxable person and providing this decision is governed by the guidelines and regulations overlined in the tax procedures law. This transparent process ensures that the taxable person are informed of the outcome of the refund application in accordance with established legal procedures. With this, we end the first half of the session, and now You may post your questions in our chat box and we will try to resolve your queries.